You have $100,000 in cash sitting in your checking account, doing nothing. Maybe you sold a business. Maybe you got an inheritance. Maybe you saved aggressively for years. Doesn't matter. The question is the same. What do you do with it? Because leaving it in cash is a decision, and it's probably the wrong one. Inflation is eating away at your purchasing power every single day. That $100,000 loses value just sitting there. But deploying it incorrectly is worse than leaving it in cash. Put it in the wrong investment and you could lose half of it. Make an emotional decision and you'll regret it for years. So what's the best way to deploy $100,000? Here's the framework and the specific allocation that makes sense for most people. Step 1. Handle the basics first. Before you invest a single dollar, you need to handle 3 things. These are non-negotiable. Pay off high-interest debt. If you have credit card debt, personal loans, or anything charging more than 7% to 8% interest, pay it off immediately. There's no investment that consistently beats the guaranteed return of eliminating high-interest debt. Build an emergency fund. You need 3 to 6 months of living expenses in a high-yield savings account, not invested, not in the market, liquid cash you can access immediately if you lose your job, your car breaks down, or something unexpected happens. This is your safety net. Don't skip it. Max out retirement accounts. If you're not already maxing out your 401k and IRA, do it. For 2026, that's $23,500 in your 401k and $7,000 in your IRA. That's $30,500 of tax-advantaged investing you're leaving on the table if you're not doing it. Max those out first. Let's say you do all of that. You pay off debt. You set aside $30,000 for an emergency fund. You max out retirement accounts. You still have $40,000 to $70,000 left. 60% stocks, the growth engine. This is where the majority of your long-term returns come from. Stocks have historically returned about 10% annually over the long term. Over decades, this is the wealth-building engine. But you're not picking individual stocks, you're buying the entire market. $40,000 in a total U.S. stock market index fund. VTI, Vanguard Total Stock Market ETF, or FSKAX, Fidelity Total Market Index Fund. This gives you exposure to every publicly traded company in the U.S., over 3,500 stocks, $15,000 in an international stock index fund. VXUS, Vanguard Total International Stock ETF, or FTIHX, Fidelity International Index Fund. Exposure to developed and emerging markets outside the U.S. You're not buying Tesla, you're not chasing hot stocks, you're building a diversified portfolio that captures market returns with minimal fees. Expense ratios on these funds are around 0.03% to 0.15%, basically free. 20% bonds, the stability. Bonds are boring, and that's the point. They don't grow like stocks, but they also don't crash like stocks. They provide stability, generate income, and give you something to rebalance into when stocks drop. $15,000 in a total bond market index fund. BND, Vanguard Total Bond Market ETF, or FXNAX, Fidelity U.S. Bond Index Fund. $5,000 in Treasury Inflation-Protected Securities, TIPS, or I-bonds. These protect against inflation. I-bonds are currently yielding around 4% to 5%, backed by the U.S. government. Buy directly at treasurydirect.gov. Limit is $10,000 per year. The bond allocation cushions your portfolio when stocks crash and gives you dry powder to buy stocks when they're on sale. 10% real estate, the hedge. You don't need to buy a rental property. You can get real estate exposure with $10,000 through REITs and crowdfunding. $7,000 in a rate index fund. VNQ, Vanguard Real Estate ETF, or FREL, Fidelity MSCI Real Estate Index ETF. REITs own commercial real estate, apartments, warehouses, data centers. Required to distribute 90% of income as dividends. $3,000 in real estate crowdfunding. Platforms like Fundrise, Realty Mogul, or CrowdStreet let you invest in private real estate deals with as little as $500. Higher potential returns than public REITs, but lower liquidity. Typically locked in for 3 to 5 years. 10% cash or alternatives. The flexibility. This is your opportunity bucket, the cash you keep liquid for the right opportunity. $5,000 in a high-yield savings account, earning 4% to 5% right now. Keeps up with inflation, liquid, safe. This is money you can access if a better opportunity comes up or if you need it for something unexpected. $5,000 in alternative opportunities. This could be anything. Angel investing if you're accredited, peer-to-peer lending, commodities, crypto if you want high-risk exposure, a side business. Whatever fits your risk tolerance and interests. The execution plan. Don't try to time the market. Don't wait for a crash. Option 1. Lump sum invest immediately. Statistically, this beats dollar cost averaging about 66% of the time. Time in the market beats timing the market. Option 2. Dollar cost average over 3 to 6 months. If deploying $100,000 at once makes you nervous, spread it out. Invest $16,000 to $33,000 per month over 3 to 6 months. Don't stretch it out over a year. You're just leaving money on the sideline. What not to do. Don't pick individual stocks. Buy index funds. Don't put it all in one thing. Diversification is the only free lunch in investing. Don't invest money you'll need in 3 to 5 years. Keep it in high-yield savings. Don't pay high fees. Avoid actively managed funds with 1% expense ratios. Don't panic sell when the market drops. If you can't handle a 30% to 40% drawdown, adjust your stock-to-bond ratio. Here's the allocation again. $60,000 in stocks, VTI, VXUS, and optionally a small cap value tilt $20,000 in bonds, BND and TIPS or I bonds $10,000 in real estate, VNQ and optionally crowdfunding $10,000 in cash or alternatives, high-yield savings and flexible opportunities. This assumes you've already paid off high-interest debt, built an emergency fund, and maxed out retirement accounts. You're not getting rich quick. You're building wealth slowly and consistently over decades. Deploy the money. Don't overthink it. Don't wait for the perfect moment. And don't touch it for at least 10 years. Time in the market beats timing the market every single time.